Hi class, in this video I will be doing or showing you guys how to prepare the statement of retained earnings, which is the second financial statement in order that accountants must prepare for companies, as well as the balance sheet. All right, let's get started. The Flower Arrangements Company has just completed operations for the year ended December 31st, 2024. This is the third year of operations for the company. The following data has been assembled for the business. So we're going to click this data table and you see all the accounts listed with their ending balances. Now some of these accounts we're not going to need, but as well, let's pull this up. They also give us the income statement, and that is why there is an order, because there's a number on the income statement that we're going to need in order to prepare this statement. Okay, so let me close that out. All right, we've got the heading. So remember the name of the company, the name of the statement, and then for the period of time. So this, if you read the instructions, it says for the year ended. So year ended December 31st, 2024 goes next. All right, so the statement of retained earnings basically tells us how much money we have reinvested or put back into our company for a particular period. So we've got to start off with the beginning balance that was left over from the prior year. So that would be January 1st, 2024. That's the beginning balance, okay? And you can see that number was given to you and it's 4,900, okay? It's right there. Things that add to the statement of retained earnings, that's money that we have made throughout the year that makes retained earnings go up. In other words, that's our net income. So let's click this and we're going to use the net income number on the income statement, 18,500. So net income for the year, that makes retained earnings go up. That's more money that we can put back into our business. So we've used that statement, so we're going to click done. And next we're going to get a subtotal. So we're going to pull our calculator up. 4,900 plus 18,500 gives us a total of 23,400. Now let's talk about things that make retained earnings go down. Expenses make it go down, but we've already put that or taken that into account because expenses were subtracted to get net income. Something else that makes retained earnings go down is dividends. Dividends makes retained earnings go down. That's less money we can retain. Dividends represents money that the company has paid out to its shareholders. So that would be listed next. Okay, and then we're going to put the amount of dividends, which is 5,000. And then remember that makes it go down. So when we get our ending retained earnings balance, we're going to subtract the dividends from that subtotal. So 18,400. That is our ending retained earnings balance. So next year, 2025, when we do the statement of retained earnings, this number, 18,400, will be our starting number. Okay, so this is the statement of retained earnings. Let's check answer and let's do the next one. I'll do the next one in the same video. This is the balance sheet. So the balance sheet tells us as of this point in time where we stand, like what's our total assets, our liabilities, and our equity. It's basically the accounting equation in a report. Okay, so name of the statement, this is Sassy Arrangements. Name of the financial statement, which is balance sheet. And then now this is what is different from all the other statements, is the date. The balance sheet shows us like a snapshot of our business. As of this date, these are our assets, these are our liabilities, and these are our equities. So it's not necessarily for a period of time. Like the income statement was just for a year. The retained earnings statement was just for a year. The balance sheet, the beginning date is when they first opened their doors. So that could have been 5 years ago, 3 years ago. And if you read, that's actually 3 years ago for this company. So we're just going to put the date, December 31st, 2024. And this one's kind of laid out for you. It's got assets on this side, liabilities and equity on the right side. And the total should equal. That is the accounting equation. Assets equals liabilities plus stockholders' equity. So we're going to pull up this data, the data table, and we're going to start filling in the assets. So remember, assets are anything that the company has possession of or owns or has rights to that's going to benefit the company in the future. Things like land, building, cash, supplies, inventory, equipment. All these are things that the company owns that's going to benefit that company in the future. So let's start with cash, and that is 7,000. Okay, and then next, looking for assets, we have office supplies. That's going to benefit our company. The more office supplies we have in our facility, in our administration building, the faster we can do our job and serve customers. So that's going to benefit our company in the future because hopefully that will generate more sales and that will generate more cash. Oops. And let's see, accounts receivable, that would be listed, 5,500. Accounts receivable represents money that is owed to us. So hopefully this will turn into cash in the future. And I'm going to get in the habit. I'm going to get you guys in the habit of putting these in the correct order. Okay, so 5,500. We'll talk about order later. In chapter 2, let's see, office supplies. That was 1,900 because there is a specific order: cash, accounts receivable, office supplies, and then equipment. And then a grand total assets, and let's calculate that. 7,000. Oops. 5,500. So our total is 43,600. Total assets. So this total over here, liabilities and equity, for our equation to be in balance must also equal $43,600. So I'm going to just go ahead and put that there. To make sure, that's a check for me, to make sure that our accounting equation is in balance. So our liabilities are money or services that's owed to an outside source. So normally these accounts have the word payable behind it, like accounts payable. Don't get confused with accounts payable and accounts receivable. And accounts receivable is an asset, because that's money that is owed to us. Accounts payable is a liability. We owe that money to an outside source. Okay? And stockholders' equity, there are two components of stockholders' equity. It is common stock, 9,500, and retained earnings. And look here, don't get confused and put the $5,000. That was, look at your date. That was the beginning of the year's balance. We want the end of the year. Look at this date. We want the end of the year. So we're going to have to look at the previous statement, the statement of retained earnings. And it shows 24,900. So that's the number we're going to put in our balance sheet. 24,900. Let's do the math. 9,200 plus 9,500 plus 24,900. That gives us $43,600, which is what it should be. So that is a balance sheet. We've got assets on one side, liabilities and equity on the other. So I hope this helps, and stay tuned for more videos.